So looking at recent Bitcoin news, and a lot of buzz has been sparked by this Bloomberg story, with the article revealing that an academic paper from 2018 that purported to evidence that tether flows were responsible for over half of Bitcoin's price moves during the 2017 bull run has been updated. The paper, titled Is Bitcoin Really Untethered, and authored by Griffin and Shams, now asserts that over half of Bitcoin and several altcoins' price moves from March 2017 to March 2018 can be directly tied to the capital flows of one major entity, with the authors claiming to have identified said entity through analysing the flows of USDT from the Tether treasury across major exchanges. In particular, the report focuses on highly correlated flows of BTC and USD from Bitfinex to Poloniex and Bittrex, with the authors claiming to have verified that, quote, flows identified on the Tether blockchain moving out of Bitfinex and to Poloniex and Bittrex correspond to opposite flows back on the Bitcoin blockchain, which come out of Poloniex and Bittrex into Bitfinex, end quote. According to their analysis, quote, the two series are correlated at 0.72 for Poloniex and 0.71 for Bittrex at daily intervals, and that they also have similar magnitudes, end quote. Additionally, the report notes that, quote, the Bitcoin flow between other exchanges, even between other Tether-based exchanges and Bitfinex, have much lower correlations with the Tether flow to Poloniex and Bittrex and a much larger difference in magnitude, end quote. The report determines that 81% of the Tether flows from Bitfinex to Poloniex and Bittrex are made through one large deposit address for each exchange. This account is responsible for 47% of all Tether flows from Bitfinex to all Tether exchanges combined. Additionally, 52% of the Bitcoin flows back to Bitfinex from all Tether exchanges goes into a single deposit address on Bitfinex. If these USDT and BTC flows are correlated, the researchers argue that such, quote, suggests that all these wallets are likely controlled by the same entity, which sends the printed Tether into the market in exchange for Bitcoin, end quote. The authors found correlation to be 0.69 for the Bittrex flows and 0.64 for the Poloniex flows, noting that, quote, flows to other large deposit accounts on Bitfinex do not come close in terms of correlation or the magnitude of flows, end quote. Building on their previous analysis, Griffin and Shams tracked 3-hour periods of lagging price action that followed the top 1% of USDT flows by volume between March 1st, 2017 and March 1st, 2018, and compared such with random samples of price data occurring outside of the top 1% of Tether flows in order to assess whether the price action following major USD circulations was anomalous. From March 2017 to March 2018, the price of BTC rose from approximately 1,191 USD to 6,929 USD, producing a gain of 481.8%. During this period, the report found that the 95 hours comprising the top 1% of hours with the strongest Tether flows were, quote, associated with 58.8% of the Bitcoin buy and hold returns over the period, end quote. The researchers removed the price action associated with the top 1% of Tether flows and replaced them with random 94-hour samples of BTC price performance. The authors repeated this process for 10,000 draws, concluding that said performance, quote, does not happen by chance, end quote. The report also looked at the performance of 6 other cryptocurrencies during the same period, finding that the top 1% of the entity's USDT flows could be tied to between 53% and 79% of the gains produced by the 6 altcoins over the same period, with tests involving the substitution of random 95-hour blocks of price action generating modelled returns of 64.5% less on average across the alternative cryptocurrencies. So, unsurprisingly, the paper has garnered criticism from Bitfinex. Bitfinex's general counsel, Stuart Hoegner, described the findings as foundationally flawed and lacking academic rigour. He asserts that the paper was based on flawed assumptions, incomplete and cherry-picked data, and faulty methodology. Griffin's rejected his statement, saying that the new version wasn't even released when they made their comments, so they are claiming something isn't rigorous that they haven't read. They denied the original version too, but have never been able to point to anything. The original paper claimed, and this paper shows even more evidence, that there was at times insufficient backing for Tether. Bitfinex denied this too, but in court filings they have admitted as much. So Bitfinex isn't the only representative of the crypto industry to have directed criticism at the updated paper. Matty Greenspan of eToro has refuted the report's assertion that it was a single actor and not surging retail demand driving the 2017 bull run, stating, "Good thing I was there to personally witness the millions of retail accounts opened at eToro during the 2017 rally." So Jeremy Allaire, the co-founder and CEO of Circle, Circle owned Poloniex, although Poloniex is soon spinning onto its own. He took aim at both the paper and the Wall Street Journal who broke the story, stating that the reporter seems to completely misunderstand how stablecoins work and how dollars flow into and across exchanges. He states that stablecoin issuers respond to inflow and outflow demands from crypto traders and investors. So, for example, last week when there was a BTC rally on China news, we saw large inflows into USDC, which led to a single address creating a lot of USDC and then flowing to exchanges. Exchanges use omnibus wallets that pull all customer balances and transactions on and off the exchange. So an analysis that shows a single wallet was involved in flows from Bitfinex to other exchanges is meaningless. All it shows is that traders were trading. In 2017 to 2018, there was demand for buying BTC and a massive altcoin rally. The majority of that demand came from Asia and China, and since there were no CNY ramps into BTC, everyone went to offshore USDT processors. These processors would then generate large prints of USDT. The only thing this supposed analysis shows is that Asia traders demanded fiat to buy BTC and other altcoins on exchanges around the world. We all know that the USDT prints had an origin in Bitfinex managed treasury wallets. Blockchain data actually only shows when new fiat tokens came into existence and how they flow through trading markets. The analysis is useless unless you can also see the payment processing and transaction banking settlement flows of Tether, which is not public. And again, really shoddy reporting from WSJ. Bruce Fenton also chimes in, describing the report as bad science. He states 119 pages of pseudo-economic technobabble based not on objective research but on a bad premise that the author really wanted to be true. So the community seems pretty divided on this story, as always seems to be the case regarding Tether controversies. Stablecoins obviously comprise a major ramp for capital to enter the crypto ecosystem, so identifying that major injections of capital via Tether have led to increased buying doesn't necessarily mean manipulation. The issue for me is the opaque nature of USDT issuance. I personally know someone who has been on the Tether waiting list for years, suggesting that Tether may not comprise an easy ramp for everybody to enter crypto. In any case, I'd love to hear what you guys think. Check out the report, have a look at some rebuttals, and let me know your thoughts in the comments section below. Don't forget to rate and subscribe for more news and market analysis. Happy trading.